Well, hello again. This is Professor Atchley, and today we take up Chapter 5, Intermediate Accounting, and we're going to look at elements over time, including the income statement in particular. Today's chapter is fairly lengthy, so I will abbreviate here and there, but be sure to read the entire chapter carefully in order to get the full content. We begin by explaining the difference between net income and comprehensive income. And then we will assess the usefulness and limitations of the income statements as practiced under generally accepted accounting principles. Comprehensive income is change in a company's equity during a period of time resulting from transactions and other events and circumstances from non-owner sources. Comprehensive income is the sum of net income and the other comprehensive incomes. Net income is a measure of financial performance resulting from the aggregation of revenues, expenses, gains, and losses that are not items of other comprehensive income. Other comprehensive income, OCI, it's called sometimes, is revenues, expenses, gains, and losses that are explicitly excluded from net income in specific accounting standards. By the way, under the U.S. and IFRS international standards, these are fundamentally the same. The advantages of the income statement include three. It provides confirmatory value. It has predictive value, number two. And number three, we can assess the risks or uncertainties of achieving future cash flows using the income statement. The disadvantages are also three. Certain revenues, expenses, gains, and losses that cannot be measured reliably are not reported on the income statements. Number two, the measurement of income is dependent upon the accounting methods elected or selected. And number three, even if management is not intentionally biasing the earnings figure, different judgments will lead to different income numbers, resulting in a lack of comparability. This concludes learning objective 1. Now we turn to defining earnings quality, including permanent and transitory earnings and earnings management. Earnings quality captures the degree to which currently reported earnings provide financial statement users with information that is useful, particularly in predicting future firm performance. Permanent earnings are likely to continue into the future. Transitory earnings are not likely to continue into the future. Earnings management occurs when management uses the discretion afforded on them under the accounting standards to inappropriately manipulate earnings to meet certain goals. Obviously, this is unethical but widely practiced. We turn to goal number 3, identify 4 primary elements in the statement of net income and explain the nature and function of approaches to classifying these various items. The 4 primary elements used in a statement of income you're already familiar with. They include revenue, expenses, arranged by nature or function, by the way, gains and losses. The Securities and Exchange Commission requires presentation by function, so this is the practice of large corporations. The standards are similar under the international standards, so we need not comment here. Number 4, explain the presentation of the income or statement of net income, including the multiple step and single step formats. 2 common income statement formats are, first of all, the single step income statement. This format combines all revenues and gains and all expenses and losses into single categories. The net difference, of course, is net income. A multiple step income statement format reports several critical performance measures before computing income from continuing operations and net income, including the following: gross profit, operating income, income before tax, income from continuing operations before tax when discontinued operations are included. Number 4, income from continuing operations, 5, net income, and 6, earnings per share. The IFRS allows multiple step and single step statements, but has additional requirements. They require certain line items be reported on the income statement. These would include the following: revenue, sales revenue, also called turnover; financial costs, share of income or loss of associates; tax costs, finance costs rather, share of incomplete loss of associates, or share of income or loss of associates; tax expense; after-tax profit or losses on discontinued operations; net income, also called net profit or net loss. The company presents additional items, some subtotals where relevant to the understanding of its financial performance. The company is required to disclose certain other items if they are not presented on the income statement. That would be, of course, in the footnotes. Certainly the international standards are more exacting, and we are moving the U.S. standards in that direction. Now we turn to an examination of income from continuing operations, including the components of operating income, non-operating income, and the income tax provisions. Net income from continuing operations is income from portions of the business that are expected to continue into the future. It is commonly presented as the sum of these income statement items. There are 3: operating income, revenues and expenses from the entity's principal operation; non-operational income items, gains and losses, along with revenues and expenses resulting from peripheral activities of the company. This would include items with an unusual nature and or infrequent occurrence. A transaction or event is unusual if it possesses a high degree of abnormality and is unrelated or only tangentially related to the ordinary activities of the entity. A transaction or event is infrequent if it is not reasonably expected to recur in the foreseeable future. Lastly, we look at income tax provision. Reports the income tax expense associated with all income items, including income from continuing operations. These can be similar to the international standards. However, there are additional requirements covered under the international standards, as expected. We are now looking at a demonstration of accounting for discontinued operations. This will include the criteria used to determine a discontinued operation presentation or the statement of it, or to report it on the statement of net income. Companies report discontinued operations for various income-related items associated with portions of the business that have been disposed of or are in the process of being disposed of. The portion of the entity that is viewed as a component may be a reportable segment, an operating segment, a reporting unit, a subsidiary, or an asset group. Discontinued operations are reported net of taxes on the income statements. For discontinued operations, companies must disclose these items: pre-tax income or loss, pre-tax income or loss attributable to the company's shareholders, major line items to arrive at pre-income tax or loss. Note that we don't have to put in complete, just major items. Reconciliation of the major items making up the pre-tax profit or loss, disclosed in notes to the after-tax profit or loss presented in the income statement. Carrying amounts of the major classes of assets and liabilities included as part of the discontinued operation and classified as being held for sale. Also, gain or loss on remeasurement of net assets held for disposal. Reconciliation of the carrying amounts of major classes of assets and liabilities disclosed in notes to total assets and liabilities and classified as held for sale in the balance sheet. Total operating and investing cash flows. This comprises the entire list. For individually significant operations, companies will disclose pre-tax incomes or losses and the amount attributable to the company shareholders. This is the basic principle at work here. There are a number of similarities and differences between the U.S. and international standards, and at this time we will pass those over lest we have just a forever video. We have 3 more sections or 3 more learning goals to consider. Let's take them quickly in order. The presentation of net income, non-controlling interest, and earnings per share on the statement of net income. Net income is presented after discontinued operations. Net income is separated into net income attributable to shareholders and net income attributable to the non-controlling interest. There is a non-controlling interest when one company controls another company, but owns less than 100% of its voting shares. A controlling interest, of course, would be 51%, so that brackets the holdings for you. Earnings per share represent the amount of earnings assigned to each outstanding share of the company's common stock. Companies report earnings per share by continuing operations and discontinued operations in a supplemental section of the income statement directly below the net income or loss for the period. Next, learning objective, the statement of comprehensive income. Companies have 2 choices in reporting comprehensive income. First choice, in one statement, usually called the statement of comprehensive income, or in 2 consecutive statements, the statement of net income and the statement of comprehensive income. The OCI consists of the following 3 items: unrealized gains and losses from availability for sale portfolio of investment securities and derivatives classified as cash flow hedges. Corporations carry large amounts of paper sometimes to prepare themselves for upcoming cash outlays and making use of the time in which that cash is held to generate a minor financial return. Sometimes the financial return is not so minor if the amounts are substantial. Secondly, OCI consists of foreign currency translation gains and losses. Multinational firms have multiple gains and losses due to currency revaluations vis-a-vis each other as they hold balances in different types of currencies. And thirdly, unrecognized pension costs or benefits from adjustments needed to bring the accounting pension asset or liability of the funded status of the pension plan into conformity. All operating costs income items must be shown net of tax. The tax effects can be applied in total or on each individual item comprising other comprehensive income. The comprehensive boy, that's hard to say a few times, huh? Operating comprehensive income is treated similar under the U.S. and international standards. Last of all, we described the components of and the reporting requirements for the statement of stockholders' equity. The statement of stockholders' equity, of course, summarizes the changes in equity both by account and in total during the period. The accounts summarized are the following 4. Contributed capital accounts. This would include common stock, treasury stock, preferred stock, and additional paid-in capital. Number 2, retained earnings. Number 3, accumulated and or other comprehensive income. And number 4, non-controlling interest. A statement of stockholders' equity is not required under U.S. GAAP. However, the Securities and Exchange Commission requires a statement of stockholders' equity. The Foreign and U.S. standards are similar in this regard with very minor differences. And that completes our introduction to Chapter 5, Statements of Net Income and Comprehensive Income. We will next week turn our attention to the balance sheet and point-in-time measures of economic and financial activity. Thanks. Have a good time reading that chapter, and we will see you in class Monday.